Hi, I'm Don McCulley.
Hi, I'm Andrew Kuykendall. Welcome to another episode of This Stuff's Complicated, our attempt to try to take some of the confusion and terrors out of self-funding.
But not night sweats.
No, absolutely. We got to keep the night sweats.
Okay.
So what are we talking about today, Don?
Your t-shirt first, Andrew.
Sao Jorge. You ever seen the movie The Life Aquatic?
No.
He was the guy, well, when you watch it, he's the
Okay.
guy with the acoustic guitar singing David Bowie songs in Portuguese.
Oh.
He is an individual specifically singing.
Is the whole movie in Portuguese or just the song?
There is enough Portuguese in the movie that's beyond the song, but there is enough English that you'll be able to follow along easily.
Well, remembering that Portuguese is the only language used in South America by Brazil, everyone else is Spanish. Let's get into individual specific limit now, okay?
Good call.
Okay, thanks. In 2010, we got in the space. Explaining individual specific limit was complicated. Having said that, the way our block worked out for the first 5 years is the individual specific limit premium added up to about 30% of the total spend.
And the individual specific limit is often referred to as the spec-deductible or the individual-deductible.
Or the ISL.
ISL.
Let's use ISL because
Yep.
that way I don't have to fumble over the word. So the ISL minimum back then was $20,000. So we picked almost everybody in a $25,000 specific limit because we were looking at 50 to 200 life groups. And they tended to be on the smaller side. So the first thing you do is you look at the maximum liability or the fully insured spend and say, okay, how much is the specific premium, the ISL premium, in relation to the current fully insured spend? And if that came out to be about 30%, that's where you set the ISL. So those range between $25,000 and $50,000 for the first couple of years. Another way to do it is if you have the underwriting worksheets from the fully insured carrier and you can look at the internal pooling levels that the carrier used, even though that's a different set of large numbers, because insurance is the law of large numbers.
Yeah.
It's a different set of law of large numbers. It could still be applicable because you could use this employer and say, yeah, that feels right. Look what they've done for the last few years.
And when we were consulting with our members back in those days, and even when we're consulting with people now, it's just a good reminder to them, not everybody in your population is going to hit their individual specific deductible.
Right.
So once you get to 25 or 50,000, the next level of claims is paid by the captive, ultimately paid by the excess. But earlier on in 2010, to your point, a lot of what we were dealing with was people who were understandably quite concerned about their ability to come up with a check of $25,000 times how many employees.
Right. And they thought that was going to happen. They didn't understand liability. But this is the fixed cost portion that sets the ISL. And it should be between 10 and 50% of your spend. And after 3 or 4 years of self-funding, if it's near 50%, your premium's near 50% at the ISL, you probably need to look at raising it. There's a couple ways you look at how to raise the ISL. One is you might hire an actuary or your agency might have an actuary, and it just says, hey, this should be higher, right? Another is something we noticed a few years ago is we had a group that had like 6 or 7 claims between, say, $25,000 and $50,000. That was logical for us to raise that ISL from 25 to 50 because those claims paid inside the captive, inside the stop loss limit, are about 15 to 30% higher cost than a claim paid directly by the employer.
And also, medical inflation is a very real thing. It is continuing and compounding at a much greater rate than most spending out there. So trying to keep the same specific limit over a 3 to 5 year span, you'll actually find yourself falling further and further behind.
Right, but also it comes down to the area you're in, right? So in California, a normal birth is, $30,000 or $40,000, right?
Or 60 now.
60,000, right? But when we started, it was closer to 30. In North Carolina, that same normal birth is about 10,000. So you can have lower individual specific limits in a place like North Carolina because the area factor of underwriting, we'll talk about that another time. But the cost of medical care also contributes. So it's easier for us to hit a $75,000 or $80,000 ISL in California, where you're now capturing 90, 85% of the claims below the ISL, which brings us to what's the right ISL for an employer, right? How do you stress test it, right? Mm-hmm. Because I'm an accountant, right? Yeah. You have to think about what's the liquidity position of the employer? And we don't review financial statements. We assume everyone's got a healthy balance sheet. But the way to do it is, let's say it's $100,000 specific limit, because that's easy numbers, right? You think back to Miami Vice, they always talked about like drug dealers sell stuff in like round numbers, not right. So $100,000 specific limit. The stress test is 3 times the individual specific limit, less in this case $3,000. So now we're talking about $297,000. Can the employer afford to pay in a single month $297,000? And how do they accumulate that? Because if they take their maximum liability from their employer aggregate and they put that cash aside each month, at the end of 75 days, they should have most of that money laying around. They've only had pharmacy claims, right? So they've built up a 75-day reserve that will catch up over a year. Claims don't always happen in a linear fashion. They're very asymmetrical, in fact, as we've talked about. But that ISL then can be proved out, and the employer can start gaining comfort by thinking of ways to say, how do I approach this individual specific limit?
And the members that are going to approach and breach that individual specific limit are no longer the responsibility of that employer.
Right.
That now moves on into the captive layer in our instance, and then ultimately to the carrier. That's
the arc of the claims over the course of a year, right? And year being a very distinct definition.
Yep.
But having said that, that stress test is a way for an employer to gain comfort with self-funding. It also gets them to wrap their head around, if I have $1 million claim, I'm not necessarily on the hook for $1 million.
Exactly.
Right? It's the first 50 or 100,000, whatever that specific limit is, because we had to take the employer's concept of how they viewed insurance, which was just 4-tier rates, and start looking at above the employer deductible. The employee deductible of $1,000. Then you got the $50,000 for the employer. And so how do you kind of explain those things? So to recap, there were 3 things we covered in this episode. What's the correct ISL? How do you determine that? How do I stress test the correct ISL for my client? We're putting ourselves in the consultant shoes there when you sat in for 25 years. And when do you change your ISL, right? And it really comes down to that percentage of where you are in your spend, right?
Great.
Anything else we should talk about?
I think a very big part of that as well is the comfort level of the plan sponsor.
Yep, that's fantastic. Well, my name's Don McCulley.
And I'm Andrew Kuykendall. Thanks for joining us on This Stuff's Complicated.
Have a good day.